All right, it's a good start. Lot of green on the screen. You want to see a start like this, where the market breadth is 1:10, 1:11. That is a powerful start in itself. That the market breadth is off to a great start. Right after that policy, the Bank Nifty, the Sensex, and the Nifty, all of them are off to a great start. Crude is down, yields are down, banks are up. Very, very simple to understand. Now, we've seen some short covering. We've seen a little bit of scare in the bear camp. But is it convincing enough for them to run for cover? I think that will be a function of today's credit policy communication and the move after that. Indigo is saying that we will charge you more if you fly with us because ETF prices have gone higher. Now that ETF prices have gone lower, will they reverse that taxes? That's pricing power for you, my friends. If they go higher, companies will say it's because of raw material cost. And when raw material costs they reduce, and if they are confident that demand will be sustaining, they will not cut everything back. But for you right now, Indigo is flying high at 25.50.
Yeah, but the Singapore GRM fall all the way to $4.45 per barrel versus the recent high of 15.4. That definitely must not be spelling good news for Reliance Industries, for HPBP IOC, or for that matter, even for MRPL or Chennai Petroleum, although you're not really seeing much of a damage coming there. But yeah, that continues to be something that you may want to look out for. Bajaj Finance, what's that big boy up to? The board has now approved a fundraise of in total 10,000 crore rupees, 0.5% higher for Bajaj Finance. 78.90 is where that stock is currently sitting at. GCPL and poor commentary coming in from there. The second quarter update is also hinting at a low single-digit organic sales growth versus which is weaker than what the market was anticipating. And that's really not going down well with the likes of GCPL. Marico also came out with a disappointing second quarter update. So these stocks are in focus. Tata Motors, the JLR Q2 wholesales are up by about 29%. Free cash flow guidance of £300 million. Tata Motors, 724 is where that stock is right now. Ujjivan SFB, that's come out with its quarterly update. Total deposits have seen an uptick of 43%, CASA up 27%, stock gaps up 3.5% right now. Kalyan Jewellers as well, wherein the India operational revenue growth has come in at 32%, 3.5% higher for Kalyan Jewellers as well as we speak right now. And then Nykaa too, wherein the beauty personal care business is likely to see a net sales growth of 20%. The street is liking at least that much, 2% higher for Nykaa, almost touching that 150 odd mark in trade. That said, let's also check in on what HDFC Bank, Infosys, Axis Bank, the kingpins from within the Nifty are up to. HDFC Bank marginally higher, Infosys 0.5% uptick, TCS will come up for you on your screens next, Axis still pretty flat. Kunal, what's the take on the index? We're already looking at 19,600 here.
Yeah, so I think it's a good start. We've opened with a gap on the Nifty, so that also is a strong confirmation that maybe the trends are still positive for the index. We'll again wait out for the event to pass by, and hopefully the index is sustaining about the 19,600 mark by the end of the day. In terms of opening trade, Bajaj Auto is something which looks attractive. So that's a stock which even yesterday managed to make a decent comeback. It's holding on towards a key support point, even of a 50-day moving average. So that's a stock which I look to trade in the opening.
Right. Naresh, what about your opening trades?
So that would be a buy on Sun TV, which gave a breakout yesterday. It looks interesting at 625 to 632 levels. Could see a breakout moving forward.
All right, Sunil Subramaniam joins us. Let's connect with him and let's say hello to him. Sunil, good morning. Thank you for joining us. Are you joining us from Chennai?
Yes.
I'm surprised. There is a match on Sunday. You should be standing outside the stadium. Lamba line hoga, bhai lag jao udhar.
अरे चेन्नई में मैच है ना?
हाँ, so you should be standing outside the stadium. It will be a long line, no? You should queue up right now.
तो लाइन क्या? लाइन की बात नहीं उठती है.
You got the tickets?
Yes.
Great. Enjoy the match. Enjoy the match. Okay. Markets. Bit of a yes and no here. Bond yields are going higher. FIs are selling. The logic is that if yields are going higher, FIs will sell more, and that will weigh down Indian markets. Is there logic in assuming that?
No, some amount, but I would say that it's more about the trend in future yields rather than the absolute level of the yields. Okay. Why I say this is interest rates have been high in the US for quite some time. And from April onwards, you've seen while emerging market flows have been pressure precisely because of the yields, India had been receiving flows despite the higher yields. So it is the trend line that matters, because for India, more than yields, it's the oil price trend that's more critical. So I think as far as FIs oriented towards India is concerned, the higher yields in the US have more or less been factored in. It's the oil price trend which affects India's fiscal as well as inflation and a whole host of EPSs of companies. That's much far more of a concern. And that's why the rising oil price is probably, I would rate it at a higher risk factor in terms of flows as compared to yields.
Sunil, historically it is seen that when mid-cap level stocks reach the current levels based on 1 year forward P multiple, a very simple yardstick, the future returns, they get compromised. Are we reaching that stage where past returns may not be the indicator of future?
Not at all, Nikunj, because this 1 year forward PE as a measure, right? It's something that as allocators look at. So if there is somebody who's got a pot of money and says how much I put large, mid, how much in small, he looks at these valuations to decide his inter-asset allocation. But a fund manager who's doing bottom-up stock picking, first of all, when he's picking a stock, he's looking at a 3 to 5 year forward PE for that stock, discounting those cash flows to the present from a net PV, NPV perspective, and see whether today's price makes sense. So in mid-caps, because of the cyclicality, the high operating and financial leverage, this is the first year of recovery that you're seeing, in a way. So in that context, right, those mid-cap companies which are going to build off the domestic economic growth, whether it be capex cycle or discretionary consumption, are going to post higher and higher EPS growth in the coming years. And when you then factor those in, many mid-cap stocks look reasonably valued today to buy from that perspective. So fund managers would continue to buy those even though 1 year forward PEs may look rich there. So to that extent, I think that in a cyclical story, go back to 2003 to 8, we are in a very, very similar kind of a phase. The capex cycle in India is yet to really kick off. It's only the government that's been holding up capex. Private sector capex is an announcement stage, but over the next 12, 18 months has to come into play, and the mid-cap segments will benefit from a strong rise. And even a 10% rise in their top line will lead to 25, 30% rises in their EPSs because high interest and high depreciation costs. So I would say that the quality of the stock is the concern. We all know that in the mid and small cap space, retail investors come in, operators come in, a lot of rumors make stocks go up. So those kind of stocks, we don't get support from a fundamental research-oriented mutual fund, insurance company, or a portfolio management service provider, will continue to get buying support. And other thing, Nikunj, to note is that today a significant shift in the SIP flows in terms of small cap and mid caps has also happened. So because of which fund managers will continue to get installments of mid cap and small cap fund money from investors right through to keep buying good quality stocks. So I think what we are going to see is a clear separation between quality and momentum, or hawa, as you may call it.
How has Sundaram Mutual Fund off late invested? When I say off late, last 3 to 6 months, what's been the change in positioning? How have you participated in the IPO market? How are you approaching new themes and sectors now?
So for us, I think one of the key things there is that where we have had a change in stance, and Nikunj will be surprised to know this because I know you're tracking us. So we had actually gone underweight on cement a few months ago because more of valuation, not because of demand concerns, more because valuation.
Of course, I track it. Ramco Cements, how can I forget? Ramco, how can I forget? It was, I think you own 5% of the equity, right?
At one point. But
At
we
one
went
point,
through a phase where we were underweight there, Nikunj, and we are back to being neutral to overweight on cement. So that's one big change in stance. The second stance, which is that we were heavily underweight in pharma, we moved that to neutral because we see a lot of selective stocks that we can buy there. The third is in terms of, for us in the new age IPOs, we are more into buying these IPOs a few months after listing because the IPOs tend to be a bit, price jacked up, if I may call it that way. So we wait for the things to settle. And a lot of the IPOs which came over the last 1 year, 2 years, we actually didn't participate so much, but we are now buying some of those stocks in an open market kind of a situation. So the digitalization and the formalization, the new age fintechs, I think those are the spaces where we feel that the Indian economy's growth is going to be well represented, right? That apart, I think industrials and capital goods continues to be strong overweight for us. And for all the thing around banking, we feel that banking still has enough juice to be a safety plus kind of a sector. So we continue to be overweight on the banking sector.
Sunil, so bank is more like a linear theme. It's like a
Correct.
secular India bet. India will grow, economy will grow, banking sector will keep on providing capital. It held true 5 years ago, and I'm sure it will hold true for next 25 years also. But where are you spotting opportunities? Either there is deep value, or those companies or businesses are at a cusp of either market share gain or earnings recovery. Like you mentioned, pharma, cement. Can you be slightly more specific about next 2 or 3 years where you're finding a combination of either value or growth or both?
So I think that because it's a relative feature, I think what's happened is the market has diverted attention towards cap goods and infra heavily over the last few months, and hence discretionary consumption has tended to suffer. So we believe that that's the real cyclical story, if you see, because A, they are rate sensitive because EMIs are involved in the purchase of most discretionary consumer items. But second is they are highly cyclical because it's mostly mid and small cap companies, which, like I said, borrow heavily, hence interest costs are very high, and their plant and investment costs are also very high. So they are highly leveraged. So we believe that the capital allocation from the markets has not gone towards discretionary consumption as much as it should have. And consequently, that, especially the premiumization of consumption, which is a very strong, I think as per capita income grows, the premiumization, you're already seeing the beginnings of that very strongly in the automotives, in housing. You're seeing the high-end properties, high-end cars selling much, much faster. And we believe that that's a segment which is fully not tapped yet. And cyclically, you will see that the EPS growth of these companies will outpace the consensus forecast precisely because of the high leverage component. So I think on a 3 to 5 year basis, we believe that mid and small cap discretionary consumption is a very, very good, where we feel still is value. Now, from a PE ratio, it wouldn't look like value because they're discounting the current earnings or 1 year forward earnings, and the price will look like, oh, you're paying so many times that. But like I said earlier, the third, fourth, and the fifth year when their earnings really shoot up, that we are today discounting, and there we see value in terms of the whole mid and small cap discretionary consumption play. So if you ask me, that's one place where I do see value from a slightly longer term perspective, if you hold that in your head.
Sunil, what will happen to global sectors? China, metal is a bet on China, IT is a bet on US, manufacturing is a bet on Europe. What happens there?
So globally, we are not very positive on what's happening. I mean, the US GDP data and all seems to keep surprising us. But if you look at the credit cycle that's happening there, that people are revolving credit like there's no tomorrow. There's jobs, there is a slowdown. So we believe that a slowdown is inevitable. Now, between the hard landing and soft landing, you could have probability factors in. But we don't think that there's a growth story in the world yet happening. We believe that the world is going to go through an extended period for slowdown. Europe will be a little more suffering there, that's right. So any external oriented sectors tend to be underweight. This includes metals, this includes energy, and this includes even IT to that extent. So we believe that the growth story of the world is still at least a couple of years away in terms of the world booming back to growth. It's going to be an extended slowdown. There will be false alarms keep coming. So we would rather stay cautious on the sidelines. And China, the story behind China is that not only are they linked to the developed world's growth, but there's a distinct political shift of America, especially from buying from China. You see, Mexico and Canada are now getting a much larger share of imports from America. So there's clearly a political angle to the fact that they're buying less from China, adding to China's own structural problems like high wage costs, declining labor population, and all of that. So China, especially, we are not very bullish from an economy perspective, also from the transparency aspect. So overall, from a world perspective, right, I would say that for us, domestic India looks far more attractive than the world at this stage. To some extent, the flows are discounting that story, and that's there. But I still believe that our growth will continue to surprise market expectations, and hence India is the place where the bet should be.
So, one thing I'm just observing, and you've seen more cycles than me, is that these days the rate of change is very fast. Okay, boom in manufacturing, within next 3 months, manufacturing stocks are up 3-4 times. Boom in defense, within a year, defense stocks are up 3-4 times. Boom in railways, railway stocks are up 5-6 times in less than 2 years. It's happening so quickly, right?
Yes, absolutely. And that's the problem with the, I would say, hot button tendencies. One, three things I would point out here. One is the general hot button tendencies, right? Because there's so much liquidity and the desire and the demand to deliver return at every stage, every month, every quarter, everything. So the need to keep rotating among people who deploy money. That's number one. The second aspect which leads to this is also the demography. I think the investment demography is now far younger, right? And they don't have the patience and they are too eager to act. So the youth, by and large, whether it's through mutual funds or through direct equities, I think the youth of the investing population is contributing to these reactions. And the third I would mention, and this is also especially from foreign also, is the tendency to shift to algo. So in algo, what happens is you fit in certain preset formulae, right? And when you put in those formulae and those triggers happen, the machines actually trigger a buy or a sell. So I think the significant proportion of algo trading, and attached to this is also a larger story, which is that the move to passives across the world means that fund management fees overall has come down, right? So in a bit to stay competitive, while extreme active is very difficult in the foreign markets, what's happening is the smart beta, as they call it, is adding a little bit of tickers, momentum-based or factor-based investing. Now, these are again, to some extent, computering. The computer throws up a formula saying, based on track record at this stage, you put in money. And then when you put in that money, that changes the ratios, right? Because no money has flowed in, the P ratios have gone up. And then the computers say, now sell out and go to the next. So I think this is the part of the internet age, the part of the information age. We are all part of it in the information revolution. And I think we need to learn to address this and go forward. You can sit on the sidelines and keep criticizing these things. But if they're actually happening and making a difference to your life, I think best is to keep track, understand it, and make accordingly portfolio allocations at our end.
Covered a range of topics, and do send us your pictures when you're watching the match. Send us a selfie. We'll have to carry it.
Yeah, sure. Thanks.
Enjoy the match and thank you for joining us. Well, let's go to the RBI headquarters. Credit policy, has the governor arrived? Not that anybody is expecting anything large. I mean, pretty much status quo. There you go. The man of the moment, RBI governor, Shaktikanta Das. The governor of the year. I mean, a man who really has demonstrated that by simple ideas and by understanding of the economy and by just using the necessary tools which are available with the Reserve Bank of India, how an economy like India can easily sail through COVID when the rest of the world actually has struggled. I mean, hats off to Reserve Bank of India, the governor, in the way they have managed inflation, they have managed the banking crisis, how things in a sense have really moved for the market per se. Mr. G. Madhukar joins us now. I'm going to shift gears now, and he's managing director and he represents MedPlus. Mr. Madhukar, good morning. Thank you for joining us. Let's start with what is happening in terms of the general tone and the tonality. I mean, a couple of days ago, I read a report which talked about the fact that online pharma companies now are facing the heat of the reality, which is that they decided to cut discounts. They're becoming much more reasonable in terms of selling medicines, not at a discount, but at a MRP price where they make money. Is this something which could be the new normal going forward for the entire pharma retail industry?
I think we're really very far from the MRP days. I would think, it would be a huge step forward if they can actually drop the discounts from 25 promotional, 20 normal to something like 15 or 16, which is what they're trying to do right now. When I said that, the overall intensity is actually lessened a little bit, I meant that the number of promotions, the initial discounts which they would give has come down a little bit, the amount of discounts. And some of these stores are also, some of these online guys are also now reducing the discount. But yeah, we're far from getting to zero.
In terms of the general tone, the board has approved a fundraising plan. Could you explain to us that why you need to raise capital?
So you could almost say that this is just normal housekeeping kind of thing, hygiene kind of issue. We normally, companies go and get this approved in AGM. We missed that window. We decided that we'd actually like to keep this process issue done so that if the market was right, if the pricing was right, and if we feel that we needed to raise money to grow faster or something like that, we could do it in a hurry. That's the only reason, honestly. For us, we have done two things. One, the diagnostics plan itself is actually panning out nicely. It is starting to turn. And the second thing is, more importantly, the private label, which we actually launched across AP and Telangana, and now we have launched across the country in the 7 states in which we are present, has actually gotten a very good response. And that gives us, a chance to actually perhaps start expanding a little bit faster. It's early news still, but we very, very, very positive about how it has been taken up. And we thought that it would be a good idea for us to get the resolutions done, for us to get the shareholder approval in place and everything else. So when the time comes, we'll be able to really move fast. That's the only reason.
So the enabling resolution, I mean, you're not close to a fundraising at the moment?
See, as any company out there, we constantly look at the market. We look at our own share price. We look at the market out there, and we see what the prospects are for the market as we go forward. Right? We are, all said and done. While India has been doing fantastically, we are enjoying a really good, I would say, phase. Who knows how long it will last? But that, of course, can't be the only reason. So if we see the need, and if we feel that the market is holding up and our share price is fine, we don't see too much of a problem in strengthening our balance sheet.
Tell me, what's the plan for the diagnostics end of your business? Because there as well, there's stiff competition in this space and almost a price war every now and then.
Honestly, in the market in which we are there, there's actually no price competition. So we are an integrated diagnostic center where we do radiology, we do all the big radiology, which is MRI, CT, BMD, and the rest, ultrasound and all. And we also do the pathology and all. So we are like a combination of a diagnostic/wellness kind of center where people can come in for an annual checkup and get everything done, right? It's not just giving a blood sample. You can only get part of the picture out there. And that is actually super competitive because the barrier to entry out there is pretty low. You can just put up a small processing center in each city, or you can just outsource it. All you need to do is create an app, give a whole lot of discounts, and get a third party to go pick up the samples. So you're essentially, not really investing in anything else other than advertising. And that's why we have seen a lot of competition out there. And that's why the margins have, completely fallen. On the other hand, an integrated center like what we're talking about, there are only a couple of players. There's one listed player from Hyderabad, actually, and there's one from, the west of the country. There's not that many people. It is a capex heavy business, which meant that because of the high capex, you would have to charge very high fee. And because of the high fee, you saw very little utilization. And because of that, you basically ended up not having any scale and the price would be high. So we have tried to create a model in which we can cut that part completely. We have taken the capex out of the whole thing. We are operating at the OPEX cost only, trying to get the capex and our profit out through a subscription pool, to the subscriptions which we actually raise. So that part is working very well for us. In the last 1 year, we have actually had 110,000 people subscribe, and we're covering around 200,000 people through those subscription plans. So it is playing out nicely, but it is still some ways.
Apologies for this rude interruption. Just got to welcome a very special guest, and it's a very special morning for him, and that is India's biggest banker, Mr. Dinesh Kumar Khara. Khara Saab, good morning. बहुत बधाई.
Thank you very much, Nikunj. Thank you. Thanks a lot.
So, how does it feel, sir?
It's like any other day, but yes, of course, I feel that more responsibility for ensuring the bank continues to grow well and do well in all its performing parameters.
Once again, many congratulations from the ET family as well. And I'm sure with the extension, you've set some goals as well, right, in your mind. What's the vision ahead going forward?
Yeah, we were working. First of all, thank you very much for your congratulatory message. And of course, we have been working for some time now for leveraging analytics. Even we will go whole hog and see that how best we can leverage analytics for risk management, for sourcing awareness, for offering the customers the next best product which they should get, and also bringing in operational efficiency overall in the bank. So that is something I would like to have this organization data-driven and even much more focused on some of the key parameters with the help of data.
Mr. Khara, so now for SBI, there's clarity in terms of leadership. But for Dinesh Khara, it's going to be Dinesh Khara 2.0. So how will the regime change for you from Dinesh Khara 1.0 to 2.0?
No, I think part of it would be the continuation, but yes, of course, we will try to do that better over now, whatever we have been doing. So that's how it is. But yes, of course, the focus is very clear that we have to be customer-centric. We have to ensure that our core parameters be very efficient, and also we have to manage the risk very well. So that is a very clear message for all my team members.
Sir, there is credit policy today, and it's very, while it is very obvious what is expected, I want to hear your thoughts in terms of what should be the specifics and what you think RBI today could hint at.
No, I think we expect it to be paused, but yes, of course, RBI is now quite a lot data-driven, so I think they would have analyzed, MPC would have analyzed a lot of data, and the trends they would have seen, I'm sure we will get to have an insight into those trends in this policy today.
So last question, I know it's a big morning for you, so won't extend our appointment beyond this question. What are the initial indicators for the festival season? I mean, you are the right person to give us a sense as to which way Diwali Dussehra demand is likely to move, at least at a retail level.
No, I think the demand should be robust. I don't visualize any kind of a challenge for the demand. It should be rather robust, and we're all looking for that robust demand.
Mr. Khara, ek baar fir bahut badai from ET Now and ET Now Swadesh. Thank you very much, and thank you for accommodating this interview request.
Thank you very much. Thanks a lot for giving me a chance to be on the chat. Thank you.
Is Ankur Mishra there? Ankur Mishra, good morning. You broke the story. Congratulations.
Sir, I'm present at RBI headquarters.
So you broke the story. Congratulations. You got absolutely right that Mr. Khara will get an extension.
Yes, absolutely. We got it right, Nikunj. And 10-month extension was something when we spoke, market was not aware, and exactly the announcement has been made like that. And as you heard from Mr. Khara, the 10 months tenure which has been announced by the government is due to the policies of State Bank of India, which has age limitations, and hence this announcement has been made.
Credit policy today. Is Reserve Bank of India likely to raise a red flag, which is that, okay, inflation is there, but we don't want to fight? It is something which is acceptable now.
Nikunj, as you mentioned in the morning, it is more likely to be a white flag this time, because RBI is not going to give up on inflation, but at the same time you need to note that the trajectory of the inflation has been in line what was announced in the last policy. In fact, if you remember the last month's CPI numbers, they has been better than expectation. The expectation was around 7%, but it came below that. So the trajectory is moving as per the commentary of Reserve Bank of India, but time to time Reserve Bank of India governor has said that they are not going to give up on fighting on inflation till the time it comes in the target band, and hence you may see that commentary may continue, but it is a white flag, as you mentioned in the morning.
It is, fingers crossed on that one. Ankur, we'll come back to you as soon as the speech ends as well, and see you from the RBI. On that note, we're going to take a very quick break, come get back, because we've got a very special interaction with the Lemon Tree management on the other side. Lemon Tree Hotels, that's what's on our radar. Well, of course, the market as well is looking good, and just minutes to go before we are going to count down to the RBI policy outcome. There's a new launch announced by Lemon Tree of Mumbai Sky City. It's going to be India's biggest hotel by number of rooms, 669 rooms that is. So let's welcome on board Patanjali Keswani, the chairman and MD at Lemon Tree Hotels, joining in on the show right now. Mr. Patanjali, great to have you on the show. I first want to understand, where exactly is this hotel? Because to find such a sizable property in Mumbai itself must be a task.
Good morning, Avan. This hotel is very close to the Mumbai International Airport. So, in fact, if you go on the elevated road from the highway to the airport, you can't miss it because it is the single largest building from the highway to the airport, and it's on the left. So it's about, I would say, about 700 meters from or a kilometer from the airport. And as you mentioned, we've just launched it yesterday, and it is the largest hotel in India. So we are very hopeful it'll add significantly to our revenue and EBITDA.
Fabulous, and we're all waiting to actually visit this property as well. But tell me, what's the expectation in terms of occupancy, the target customer cohort, given that this is one of India's prime most hotel properties?
So we have an existing Lemon Tree Premier, which is about a mile away from this one, which is 300 rooms. And that is doing well. In summer, it did 90% at about 8,000 rupees. So we think this hotel too will do occupancies north of 80% at average rates about 12 to 13,000. So it should do well next year. When it stabilizes, it should get into a run rate of about 1 crore a day, that kind of income. And it should make about 65% operating profit.
Mm-hmm. Hi, Mr. Keswani, Ajay here. I'm also joining in the conversation. In fact, I must say that the one you're referring to now, the mile away one, I've been to that one, and it was a good experience and a very refreshing experience visiting that property of yours. I want to understand, Mr. Keswani, you're adding properties at this phase of the cycle. A lot of people saying that, 70% of the upcycle may be getting over now. But as a practitioner, I'm talking about the people who come, fund managers who come on our channel regularly. But as a businessman who's been running this business for decades now, which phase of the hospitality upcycle are we in now, which gives you confidence to add big properties in your capacities even now?
So let's go back for a minute. I don't agree that the phase is ending. In fact, the phase is just beginning. The last phase, or let's say top of cycle, occurred in 2004 to 2008, which is 15 years ago. How do you determine a phase? Is simply by likely growth of demand and known growth of supply, because supply growth can be very accurately predicted for the next 5 years, because that's roughly the time it takes to open a hotel. So future growth of supply is known to be about 5% per year in the branded hotel space, and rate of growth of demand on a secular basis is north of 9%. So demand will be in excess of supply for the next few years, and therefore, without doubt, occupancies will continue to rise and rates will continue to rise disproportionately. Typically 2 to 3 times the rate of growth of occupancy improvement is the rate growth. So for the next 4 to 5 years, there will be definitely top cycle in India. As far as Bombay specifically goes, it has the least volatility in terms of cyclical demand supply, because it is such a deep market that, even in bad times, Bombay does better than most cities in good times. So that is the kind of performance Bombay typically gives, because I'm sure as you know, it is so very difficult to get land at the right price, in the right location, and get approvals in Bombay. So on an overall basis, I am super confident that this hotel will add at least a couple of 100 crores of net EBITDA to our company.
Could you also, Mr. Keswani, map the trajectory of ARRs? Do you sense that average room rates are only going to escalate from the current levels as we go closer into the elongated festive season this time around? You've got the World Cup as well. And then, of course, the typical year-end holiday season too.
Yeah, so Avan, listen, I don't really look at one-off events because they do not materially add to a company's performance on a sustained basis, obviously. So, while the World Cup will be great, it might add 1%, 2% to your revenue. It is not an ongoing thing. I am talking about an ongoing, a sustained set of performance indicators, and that is fundamentally demand supply. Now, when I look at our business in its entirety and the hotel sector, you have to keep in mind when you say rate increase, our rates today are 30 or now 20% below the top of cycle rates that we achieved 16 years ago. So that's just giving you some perspective. The hotel industry's rates actually deteriorated and kept reducing in the last 16 years. So it'll be a catch-up. And a catch-up is what? I'm saying that our rates will go up by another 20-25%, certainly in the next 16, 14, 15, 18 months. And then we'll continue to rise because I know you will probably laugh at this, but rates of hotels in India are ridiculously low when compared to rates of equivalent hotels anywhere else in the world.
Can vouch for that. Okay, Mr. Keswani, great to have you on the show and look forward to a visit to Aurika soon.
Thank you.
Okay, let's move on. Let's quickly take a very quick break. When we come back, full tilt to the RBI MPC policy.